TV18.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. The gold prices continue to glitter as prices surge this year. In March 2023, gold prices in India have hit a record high of over 61,000 rupees per 10 grams. Over the last year, India's gold prices have seen an increase of around 20% as of April 2023. As gold glitters, silver prices too are trading at near one-month highs. So is it a good time to invest in gold? And if so, in what form and what percentage? How long should be your portfolio? Should be a short-term or a long-term goal? And what is the outlook for 2023? Joining me to take all of the discussion forward is Ole Hansen. He's head of commodity strategy at Saxobank. Ole, hi, good to have you. And clearly, gold has outperformed various other asset classes, whether you look at equities, currencies, bonds, securities, even real estate in most of the countries, with gold prices, especially in India, up 20% in last 1 year, and nearly 10% of gains is what we've seen in this year as well. How do you look gold in relation to other asset classes?
I still look at gold quite favorably. We have seen the underlying drivers turning more supportive compared with last year, when we saw this big jump in the dollar and we saw a big strong rally in bond yields. The outlook right now is still is pointing towards an economic slowdown. It's pointing towards a peak rate to emerge within the next few months, and that followed by rate cuts that in the US, that is, and that would likely continue to underpin the prices, also from the fact that we are seeing some dollar weakness occurring at the same time. Multiple other factors, which I'm sure we're going to discuss in this.
Interest rates is something that everybody is watching out for, and 25 basis point markets believe is factored in that we will see perhaps on 3rd of May. When you talk that when you say that we are nearing peak and we even perhaps could see rate cuts coming in before this year ends, what is your sense on how we're closing this year then in sense of rates?
I think we'll close perhaps with pretty close to where we are right now, because I think the market may be a little bit optimistic in terms of how much, in terms of cut they expect. Right now priced in around 50 basis points following another 0.25% hike, as you talked about. So perhaps around this level we are now, perhaps a 0.25% lower. But I think the main thing is that we're heading towards a peak situation in rates. It can either come about by an economic downturn that forces the Fed to abandon its inflation target, or simply because the outlook for inflation continues to support a reversal in the hikes we've seen in recent years, or during the past year. So peak rates previously and during the past 20 years has every 3 times that happened signaled a strong period for gold, and that's what we're looking for to be repeated.
You spoke about the dollar index as well. Any range that you're putting out on that one for this year?
Come again, sorry, I didn't get the first part.
I said the dollar index as well. Are you putting out any range for this year now?
Not particularly on the dollar. When it comes to gold, we still see it high at a record high by the end of the year.
And what levels? I mean, are you looking at 2100 coming back? As in, is that the high that you're looking at and beyond?
I think if we look at from a longer-term perspective, just look at the world as it is right now. We are seeing a de-dollarization having some kind of impact. We're seeing central banks continue to be strong buyers. We're seeing earning growth in the world's biggest stock market in the US, not showing any signs of a pickup in earnings growth anytime soon. And I think that basically leaves the playing field open to other investments. And with that in mind, and considering the risk of a weaker dollar over the coming periods, I think the long-term prospect for gold is still there. And if you look at the chart zooming out maybe 10, 20 years, the kind of formations that we're seeing having been built in the gold market could indicate that if we do see a new record high, then there could be quite a substantial move higher in the coming years. So with that in mind, I think we maintain a prospect for 2100 easily to be met at some point.
All right. You mentioned about central banks, and yes, last year was a record buying, and this year in the first quarter also the buying has continued. Though, of course, in the month of March, there have been some instances where we've seen some countries, some global banks actually sell gold too. But would you say that this could be yet another year where we would see banks as net buyers of the yellow metal?
For sure, but what's the unknown right now is really how strong that demand is relative to the price, because there might be some price sensitivity. You mentioned gold has reached a record high in rupees. We've seen record highs in other currencies as well, and that potentially could have an impact on how the central bank thinks regarding the price. So quite often in the past we've seen that the market needs to consolidate before we see additional buying. So basically, even if you're a central bank, you just need to get familiar and comfortable with the new higher level. So that may just slow down some of the price action or the buying activity that we see. But generally for the year, I see that demand continue.
Well, also, what's your sense for silver then? And because we've seen support come in for this too, but far away from its all-time highs in the dollar or, for that matter, rupee terms.
Yeah, and that's what continues to attract the investors. Based looking at gold near a record high, but silver well below its record reached more than a decade ago, and that's continued to attract some demand. I think right now we're missing a little bit the third leg in the silver rally, and that is the industrial metal space. I heard in the section just before that we talked about copper, and copper right now is still struggling to find the momentum that the market is looking for. I think until we get that, then silver may struggle a little bit to continue to outperform. But generally, having rallied by 30% during the past month, so far the correction has been very shallow, and that does indicate there are bidders in the market waiting for any setbacks to get involved. So silver looks promising as well as platinum. I think last week we saw quite a substantial narrowing of the discount between gold and platinum.
All right. You mentioned about metal. You talked about copper as well. And yes, we've seen sell come on every uptick into many of these industrial metals. The markets, while of course, are looking at lower inventories, but it is a Chinese demand which is keeping the prices under pressure. What's your sense now for the remaining quarter on where could we be headed with all of these industrial metals?
Well, I think the structural long-term outlook for copper, just looking at the availability of supply and the green transformation, is a story of strength. And we saw that just a couple of weeks ago when copper made an attempt to break higher. It triggered quite an aggressive amount of speculative buying. It basically means that buyers are worried about missing out on the rally when it comes. But the failure to break higher at that point triggered the selling that we're seeing right now, which is taking it back near the lower end of its current range. But longer term, it's difficult not to build a bullish case for copper, looking at both the supply and the demand side. And the same goes for some of the other metals, particularly those involved in the transformation.
So bullish copper, but when you look at the markets right now and how the past 1 week has been, we're looking at multi-week, multi-year highs, multi-year lows rather for many of these metals. Zinc is trading at a 2-year lows. You have steel and iron ore trading at 4- and 5-month lows, multi-week lows, as I said, for aluminum, zinc, and copper and nickel as well. What is it? On one side, of course, the markets will watch out for the US Fed. On the other side, the Chinese demand and perhaps a Chinese stimulus measure. What is it that would excite you within the metal space? What would you buy, and what kind of a risk-reward ratio are you looking at?
I would buy as I mentioned, the green transformation metals, because the electrification of the world only continue to gather momentum, and that basically means that those metals that are involved in that space, that will be nickel, that will be copper, they will continue to attract strong demand. You mentioned iron ore, and iron ore is a very China-centric commodity, 70% going to China, and we're seeing a slowdown in steel production, steel demand. We're also seeing the government stepping up its efforts to quell speculative trading in the contract. So it's been drifting lower at a time where you normally see strong demand, and I think it highlights what's happening right now with the recovery in China. It's not a recovery based on the same drivers as we've seen in the past. It's not going to be as commodity heavy as we've seen in the past. So that basically means it's not steel and concrete that you should be looking at. You should be looking at some of the more finer metals. And again, I'll point out something like copper, because the green transformation is also ongoing in China.
Absolutely, and that is where you have the best of the fundamentals as well, but buying into gold, silver and platinum as well. Ole, thank you so much for joining us with your sense on all of those metals, especially precious metals as well, where you are quite bullish going forward from here. But with that, we'll head into a short break, but don't go anywhere. When we come back, we'll talk about more gold some more. We'll tell you on what, how much and where should you have gold in your portfolio. Welcome back. You're watching Commodity Champions. We continue our discussion on gold for your portfolios. Joining me now is Feroze Azeez, Deputy CEO at Anand Rathi Wealth, and Lakshmi Iyer is CEO of Investment Advisory at Kotak Investment Advisors. Thank you so much for joining us. And I hope you heard the conversation that gold prices are headed higher from here. That's exactly what Saxobank feels, that $2,100 per ounce is what we could be looking at in the international markets there. Feroze, hi. One thing, if you look at the last quarter, the last year also for that matter, we've seen gold outperform. It's given a lot of good returns as compared to other asset classes. When it comes to gold, what is, the first question is quite basic now. Do you need gold in your portfolio?
Hello, Manisha. In my opinion, yes, gold has some merit to have in one's portfolio because of its usages on 2-3 counts. One is, of course, a risk mitigation because equities behave not precisely like how gold behaves. That's one utility. That's to create a plan B in your portfolio. The second utility is to create dollar accumulation over the long periods from a personal finance standpoint. When you have education of children abroad or any other global goals which will require dollars, it's a great mechanism to accumulate those dollars. So these are the two primary purposes one can have a portfolio constituent in the form of gold. But now let me try and look at risk mitigation and see its mathematical merit of its inclusion from a risk standpoint. So if you look at the last 4-5 years, when you look at the peak to trough of Nifty, if you look at FY21, when Nifty fell from April 30th to May 18th, it fell about 10.5%. What was this return of gold in the same period? Gold was 3% positive. So similarly, if you do it for year after year and see when Nifty fell the maximum, peak to trough, did gold deliver you a positive return? If it so did, one tick mark that in one measure, it is actually a risk mitigant. That's point one. So 4 out of 5 years, if you look at it from FY21 backwards for 5 years, when Nifty fell from peak to trough, the maximum for that financial year, gold actually delivered positive returns 4 out of 5 times. That's one way of measuring its utility in the form of risk mitigation for the portfolio. And if you look at the correlation between equity and gold, mathematically, there's a formula which helps you derive the correlation. The correlation is negligible. Hence, it also says that equities and gold may, as a combination, will complement each other.
Oh, well, absolutely. So, Feroze, there are so many theories going around on how much of your holding in sense of percentage of portfolio should be in case of gold. I mean, I understand it's 5 to 10%, and some people have been even more excited, calling it 15% as well. But would you say that we should keep changing our short-term and long-term goals or portfolio for that matter in a year where we do understand that there is uncertainty? We're talking about recession. We're talking about equity markets being choppy and perhaps on the weaker side as well. Should you be increasing gold then, even if it's for the short term?
Yes, I completely agree that the dynamism with respect to gold allocation has to be higher, mathematically, again, provable. That in equity, you might have more static allocations, but gold, you need to know when to exit as well. Now, like if you look at the last 3-year return, it's 17%, 17.5% CAGR. But equities on a 3-year basis have delivered 40-50% CAGR because we're speaking 3 years exactly from when COVID broke out. So point I'm trying to make is 1-year return, it has beaten all asset classes hands down. And Manisha, I remember you having called this long before it transpired. So if somebody could look at your show and then decide when to enter and when to exit and creep a primary allocation of 5-7%, a tactical allocation of 8-10%, that's when 15 becomes a number which is practical. Otherwise, if you don't have the capability of tactical allocations, then a 5-7% strategic allocation, which can be static over long periods of time, is meritorious.
All right. Feroze, would you say that Indians, as per se, when you talk about portfolios, are underinvested in gold? I mean, we do understand that every household has gold and we look for opportunities to buy gold. I mean, you as per se may not not have gold in your portfolio, but I'm sure somebody in your house has bought enough and more gold there. Would you say in that sense, in that financial sense, we still are underinvested?
You're absolutely right, Manisha. If you look at how we have imported gold over the last couple of decades, we have been one of those countries which have almost contributed to the imports of the rest of the 195, leaving the top 5 aside. So point is, yes, from a physical gold standpoint, we have gone overboard. And I think if you look at the GDP to the ratio of our GDP to the gold consumption we have had, we are the highest in the world. So physical gold, yes. So I might have my mom stacked up a lot of gold bars, but financially we are underinvested. But the good part of financial investment is the fact that you can have different vehicles. I think if you know that these 3 vehicles, gold fund, gold ETF, and sovereign gold bond, why each of these are relevant and to who and for what money, if that jigsaw puzzle can be solved, I think that's when we break the shackles of not having gold in our portfolios from a financial standpoint. And you guessed it precisely right. I don't have gold, but as a family, we do.
Yes, absolutely. You know, I've seen so many people lament saying that, oh, gold is the only one that gained, and oh, that's the only thing I did not have in my portfolio. So, well, yes, I've been hearing that a lot of time. But do you wear any gold, Feroze?
No, I don't. I have to shed the bling, so I've not owned gold as an ornament lately, for sure.
Okay. As you said, there are so many ways to buy gold if you want to include it in your portfolio, the financial asset, if you want to treat it like that. What would you say is the most cheapest or the best way to have gold or best way to own gold for a short-term or a long-term portfolio?
See, if there's a viewer listening, he or she needs to ask themselves, do they have money to buy a gram of gold at once? If they so do, then gold ETF is a great alternative. If you don't and you want to systematically build a portfolio, today we have 14,300 crores of SIP money in equity. And if that's the kind of route you have and you don't have lump sum monies, then gold fund is your only alternative. And if you are a short-term investor, with a reasonable amount of money, gold ETF comes into pictures. The third is if you're a long-term investor, you're not looking at trading, which is the core part of the 5-7% we were discussing just a couple of minutes back. That portion has to be in sovereign gold bond because if you mathematically see, you're getting a 4% gift every single year. In the form of interest and the tax rebate of capital gains. It is the only instrument known in India which has zero capital gains still. Equities are now taxed. Of course, the debt taxation impacts the debt gold funds as well. So gold fund for retail, a lump sum short-term investment, gold ETF, long-term strategic investment, sovereign gold bond. And don't ever miss a free lunch because there are very few of them in the world of investing. And 4% per annum of extra return is unbelievable. And that's because you're wanting to align the country in terms of not physical but financial goals. And that seems to be your purpose as well, rightly so many.
Oh, well, absolutely. You know, last year gold at same time was trading at 50,000. We're trading at 62,000. Add to that what you would have earned in sense of rate for sovereign gold bond as well. And you're sitting on a very happy chunk of money there. But, you know, having said that, and Lakshmi, this question is to you, even as sovereign gold bonds seems to be the place of choice when you want to buy gold for a longer term, it's just about 100 tons of kitty, and that too over the period of 6 or 7 years. And, you know, it doesn't even come at the most opportune of times. Whether it's Akshay Tritiya or Dhanteras, we do not see a tranche coming in. So it's not, when you make those calculations, perhaps it's not so profitable to the government either, is the reason we're looking at that small amount and very limited tranches. But what's your sense? What would you say is the best way to buy gold if you were doing it for your portfolio?
Clearly believe that, sovereign gold bonds, ETFs, any form of non-physical gold ownership is clearly the best way to own this asset class. But I would also maintain the fact that if you are looking at the taxation benefit, as Feroze rightly alluded to, post this index, incremental interest, going into the sovereign gold bonds. So yes, the need of the hour is to have more frequent issuances because the taxation advantage and clearly the additional free interest that you get, and that too, this is sovereign, right? I mean, nobody can really stop you from getting that. One caveat here, obviously, is that you're compromising on the liquidity, but I think that's not a material showstopper because we clearly believe that gold has to be clearly a tail-end allocation to your portfolio. Come what may, even if gold doubles from here, it's absolutely okay. It's not a financial asset class. It's just a term risk or a term insurance cover to your financial portfolio. So go for sovereign gold bonds and a combination of gold ETFs if you don't have the sovereign gold bond.
Lakshmi, when was the last time you bought gold?
You asked Feroze the question, do you wear gold? You should have asked me that question because, I don't
You would
wear
have said
gold
no. I know that, but when was the last time you bought gold?
No, I know that, but I'm saying so I neither wear gold nor do I, buy gold. I have small investments in gold ETFs and I had done a small tranche in sovereign gold bonds, but that's about it. I think if you want a wealth multiplier, asset allocations clearly should be skewed towards financial asset classes.
And not wearing it. I get your point. But this is a question I want to ask both of you. And when we talk about commodities and we talk about portfolios, gold is just the starting edge there. I mean, there are just so many commodities which have seen such volatile moves and have given such great returns. Would you say, and this one is to you, Feroze, would you say that India is, still beginning to get into commodities when it comes to a portfolio?
Yes, absolutely. You're so right. Like if you look at silver, for years and decades, we didn't have a silver ETF. Of course, silver lagged behind. Now we have a few silver ETFs. So I think unless you make a commodity financially easy to buy, logistically easy to buy, cost efficient, less management, uncomplicated, it's not possible to make it a financial instrument. But does only gold deserve to be a financial instrument in people's portfolio? The answer is no. But silver certainly does, having stood the test of time. Of course, there are other hard metals which people don't understand, but silver and gold, I think every household understands. So I'm very happy that ETFs on silver have started. And expecting a retail investor to use MCX to go long on silver and roll them over for 5 years is like a practical impossibility. So that's point two. I think we take one step at a time as a country. So silver should definitely be embraced. Unfortunately, if you look at the risk of silver in terms of standard deviation, that's twice more than gold. So a person who buys silver needs to understand that the risks are twice more than gold. So your exposure of 5 rupees on gold would imply from a risk standpoint 10 rupees on silver. So as long as an investor is able to understand and comprehend this, I think they're good to go with the silver ETF as well.
My question really is on why would not investors understand this? Because as you mentioned, gold and silver is just one starting point here. Copper, nickel, aluminum all hit all-time highs. And we've seen 30 to 40% of move come in last 12 months itself. Not just that, cotton, corn is something that international markets make such huge money on. These commodities also hit an all-time high. Currently, orange juice in US is hitting an all-time highs, and we've seen huge volumes come in on this one. I mean, I'm still waiting on when would India start trading into all of these things. What's your sense, Lakshmi?
Manisha, I think orange juice futures and trading, etc., is still some distant dream as far as Indian manufacturing is concerned. But I clearly believe that, having gold and silver definitely have made the mark. You've started seeing assets under management gradually grow in the silver ETF category, which is the right thing to do because we're looking out of the recessionary trends gradually and looking towards capacity growth across the globe. And I would say, maybe as a start point, industrial commodities, base metals, and some of the select soft commodities where India has a reasonably vibrant futures market, not so much used by retail investors. To a lesser extent, I would say that would be a stepping stone, and I don't see that day very, very far away.
All right, I have 30 seconds to close this show, but if there was another commodity that you guys would want to trade in, what would be that, Lakshmi?
For me, it will be crude oil, Manisha.
And for you, Feroze?
I think I would stick to gold and silver.
All right. Thank you.
But all of us are.
Thank you so much, guys, for joining us today. Lakshmi and Feroze for taking us through that interesting conversation on what should and shouldn't be part of your portfolio. And if yes, on how should you be including commodities there. With that, it's a wrap on this edition of Commodity Champions. Thank you for watching.